Welcome to Markets Now. I'm Michelle Rook along with Roose of U.S. Commodities. It was a mostly lower day except for hog futures and some of those deferred feeder cattle futures contracts. And Don, let's start off in the grains because it really felt like a risk-off day today with some of the outside markets kind of taking a little bit of that hawkish tone from Fed comments again.
Yeah, most definitely. I think we started out with just a commodity negative type of day where the dollar was, changed direction. The petro energies were lower. So it was that. And we unwound some of the bullish stuff from the weather. We went to the system of rain makes grain. So, and then the Russia back supportive of the export corridor again, maybe a little bit. Allowing inspection. So I think it was just a little bit of everything put the pressure on the market, Michelle.
Absolutely. And when you talk about rain makes grain, obviously wheat was also weighed on by some of these forecasts for some rain in the southern plains, right?
Well, and that's it. This time of year, we're watching the weather just ever so close. And, we're just powder dry in a big portion of Kansas. Looks like we have a chance of some moisture. Of course, we need moisture desperately soon or it's going to be too late. But I think that was part of it. And I think we looked at, even some of the other areas in the Midwest, while it's cool, I think, and maybe slowing the planting just a little bit. It's still early. So we went with that theory that we're better off to recharge the moisture.
So you don't think that corn and soybeans, do they have much weather premium in them right now? And do we need some?
Well, it's a tough one to when you look at that. I think the dominant driving force on the upfront grain market is the fact that the May-July corn spreads are telling us that it's very tight out here in the country. May soybeans 28 cents over the July, the corn 35 cents over the May, and we're 7 trading days away from first notice day. We're going to find out who wants to own the upfront supplies, but producers busy in the field or going to be in the field versus selling grain. So we've got that little tight window right now. End users still trying to cover. So the support's in the old crop and new crop is more dependent on what happens with the weather going forward.
Yeah, we're trading basically two different crops here, no doubt. And cash basis levels and basically out in the country, we're seeing a very strong cash market here for both corn and soybeans, aren't we?
Well, the end user, no doubt, continues to cover himself more on breaks now than rallies. And I think we have to remember if you look down into the southern plains, the western corn belt, we're actually going to be in a deficit and we're going to have to ration supply. So I think that's what we're looking forward to. How do we do that? When do we start doing that? And that's the support underneath the market, Michelle.
Right. So old crop corn and soybeans, though, how much farther can we push on a chart perspective? Because we're right up into some of these resistance areas again, aren't we?
Yeah, and that's a good point. We're up into resistance, but remember, we're going to have a gap in the continuation charts if May goes off at this kind of a premium. So what that means is the July is going to want to try and rally up and close that gap on the May futures, both in corn and soybeans. Either that or it's a breakaway gap and we're not going to fill it and we're going to start a trek into the new crop and look at those discounts. But probably premature to say that, Michelle. I think for right now, you have to look at the seasonalities are positive. Big growing season ahead of us yet. We need to grow a big crop as the Argentine crop was, as we know, almost 50% of normal, hard to believe. And that a little ways away before we get into Brazil corn harvest.
Let's shift over to cattle. A down day here today in live cattle futures. Was that because of the risk off of the outside markets, or are we just continuing to consolidate here after last week's reversal?
Well, I think we're all worried about, what's the demand factor of the market. And last week, remember, we just had that huge jump in cash up into some of those levels that the market was targeting for a long time. Seem unbelievable, but when you're getting close into the mid 185s. I think it was a risk-off trade is what we really had. We have gaps below the market in June cattle, 161, 157 area. So I think that is the one we're going to watch, but big discounts in the market.
Yeah, and your thoughts about cash this week are that we are going to be lower, but if we got a surprise, could we go back up and, retest the contract highs or make highs again or not?
Well, we possibly could. I mean, I think the problem with this market is the fact that a lot of this is anticipated. I mean, June cattle are running in August too, are just running a big discount to the cash, actually more than the new normal break from the spring high to the summer low, so it makes it very difficult. Cash cattle right now look steady, maybe lower, but we'll see how it goes with the futures market. Comes back, we'll probably be talking higher cash this week, but steady at best right now.
You bet. And even if we're steady, like you say, with the discount the futures have, you can't have the board go down too terrible far. We also have a cattle on feed report, though, coming out on Friday, so maybe a little bit of apprehensiveness ahead of that, or what are we expecting?
Well, I think when we look at that cattle on feed report, it's going to show us that our numbers are going to continue to tighten going forward. And I think we have to remember in the big scope of the cattle market, it's going to be 2 to 3 years before we can actually start to build supplies. So it's a long ways off. The cattle on feed report will tell us it's the start of numbers tightening, tighter numbers ahead of us. Michelle.
On the hog market, we were lower to start with, made new contract lows, and then ended a little bit higher. So is that a reversal, and can we build on that? Can we start bottoming this market?
Well, the hog market is one. Before we can go up, we have to get the cash market to move back up because the basis level is about normal on the summer months of what we normally are. So the futures probably can't go up a lot until we get the cash to go up. But certainly this week we've had more signs of bottoming than we have for a long time. So let's see what happens. Cattle hog spread sitting out here at record wide levels. So if we can pick up the demand, and second quarter supplies are supposed to come down, Michelle. It's just that the first quarter supplies were too big, larger than the fourth quarter. First quarter supplies larger than last year. So that's a problem. Too much pork. We're at the point where either sell it or smell it, and I think we're selling it at cheap prices.
Well, hopefully we can get the cash market to bottom soon and get these funds who are record long to cover some of those shorts along with. All right, thanks for joining us. Don Roose, U.S. Commodities, and that's Markets Now.